So the first approach to a capital structure is net income approach. This is a basically conceptual framework which study the relation between debt and equity and checks how the relation between debt and equity, that is whether I should go with the debt, I should go with the equity, will impact on overall valuation of my cost of capital. Now, what is the foundation of net income approach? This approach explains decision whether a firm should take about equity or debt, considering wealth creation and its return on investment. What is net income approach? As I summarized in last session, this is given by David Duran, who is also known as author of fixed K theory. As per him, the value of firm increases as debt increases and it reduces when debt is reduced. According to him, when I want to increase, I want to expand, there is a two difference between cost of capital and value of firm. Value means how many people are associated, value means how many people are recognizing, and value means how much strength I'm having that will help to expand my firm. So, as per him, when I have more and more borrowed capital, I get an authority, I get a power to expand my business. So, as per net income approach, if it's my own capital, then I have limitations because if it is my own capital, I cannot take a risk. It has limitation on quantity. It has limitations on understanding the market value. So when I have debt capital, that is a borrowed capital instead of fixed capital, then the people's advice are available. Risk-taking ability increases because more people are sharing the risk. Similarly, since more people are attached to my company, I can increase my goodwill and recognition. Now, what is key assumptions? As I said, in case of net income approach, this is a traditional approach. So, like law of demand, you'll find that no government intervention, no taxes, and cost of debt and risk. These are the two factors which are more essential. So, the first assumption will be the model operates without any taxation policy. Why? Because model talks about income, and if income is taxed, the basic purpose of tax will be not solved. So in this, the taxation is remains silent. Government interference or the flow of inflation will remain silent, and only income part is morely affected. Then cost of debt is less than cost of equity and it will constant. Please remember here this assumption is most important. If the assumption is reverse, that is cost of equity is less and cost of borrowing is more, then this theory will not work. So foundation of this theory is when you can borrow the funds from outside at a lower price, why to borrow funds on personal grounds and invest it? In simple terms, if I'm getting a loan at 5%, why I should invest money which I can invest at other place for 8%, 9%, and 10%. So what is the difference between percent? Can be my earning and I can easily repay the debt. So according to this theory, the first assumption, no change in flow of income and taxation. Second, no change in cost of debt and cost of equity. Most important, cost of debt is having less interest, less value compared to the cost of equity. So if I need to raise a capital for myself, the value will be more rather than inviting. other capital, that is bonds, debentures, and preferences. The third assumption is there is increasing debt usage and this will not affected by any factor. So the people are crazy about cost of debt. They are ready to go with the more borrowed capital. They are least bothered about equity capital because it's costing high and there is no change in of income. There is no change in rule of taxation. So these are the basic assumptions for theory of what proposed by Durant. Now let's talk about what formula he has given. Please remember, for examinations, net income approach, you need to have these formulas to be remembered. Net approach says there is a fundamental relationship between firm's value, its equity, and debt. As I explained last time, if my equity is higher, maximum profit can be retained. But if debt part, that's if D part is higher, then I have to give maximum money outside. Now, in this case, suppose I have equity 80% and debt 20%, but my debt is of lower price and equity is of higher price. Then, if I want to maximize my wealth, I should switch from equity to debt. Now, uh, let me share. I'm sharing a whiteboard for time being to explain this concept. So, the firm's value is equal to, uh, I change this sign. The firm's value will be equal to equity plus debt. Now, if I want to maximize this value, I need to increase this. Why? Because as per Durant, the cost of equity is higher. So if I say cost of equity, it is higher compared to the cost of debt. So if my equity increases, the debt part it will start reducing. So they are inversely related. And what happens? Suppose cost of equity is 50 and cost of debt is 20. So if equity part increases, the debt part will come down. But when I consider I required 5 each, then in first case, when I borrow at 50, my cost of equity will be 250. And when I borrow 5, my cost of debt will be, sorry, yes. So if I consider equity will have more cost and debt will have a lower cost. So if I want to maximize my value, then this equity portion I need to reduce. And I need to ensure that the debt portion is increased. Because if suppose in my equation 10% is equity and 90% is debt. So if the cost remains same, that is 50 rupees and 20 rupees. So for the capital of 100, 10% is what? 10 into 50, my capital will be 500, and 90 into 200, it will be 180. So capital will be 680. So when my cost of equity is less, I can definitely achieve more profit. If I take it reverse way, if suppose my value will be equal to cost of equity 90% plus cost of debt 10%, then 90% of 50 is 2250, and 10% of 20, it will be 200. So according to him, 2450 will be my cost of firm. So in earlier case, the value which I am able to achieve is 680 when my debt part was maximum. But now when my debt part is minimum and equity is more, my value will be, sorry, cost of firm will be 2450. So when I increase equity, my value is going to be increased. So as per him, if everything is constant and my borrowed capital has less cost, that is cost of debt is less, then why I should go with the own capital. Now, second proposition about this is if 1000 profit is available and I invest equity more, then I require to pay value as 2450. But when I get a borrowed capital, approximately I am charging around 600. So from 1000, if I want to repay this amount, then question is I cannot repay this. This will create a burden of loss, and this will not be income to the organization. But whereas this income 600 can easily repaid, and I can have clear 400 rupees out of my profit retained in organization. So as per this concept, if income remains same, taxation has no part, then the cost of equity and cost of debt, if I compare, the cost of equity is more and cost of debt is less, then I should not go with the cost of, sorry, equity more. I should focus on debt more. Any doubt till now? So, as per him, net income approach, which I showed, when it is 2000 and the value is less, the cost of equity will more. So, overall cost increases when I invest in equity, and overall cost will be less if I invest in debt. So, debt proportion increases, then cost of firm will become cheaper. As I said, when debt was six and less, that is 90% debt, the value of firm is 600. When the equity is there, the value of firm is 2400. So if I want to earn more profit, I should talk about more and more. I should talk about more and more debt and less equity. Now, this is just a graphical illustration. So I move further. Let's understand how this works. In case, why does debt lower overall cost of capital? Because it required less returns, you have less tax, and similarly, less weightage is given to the borrowed capital. So, as I explained, my capital structure will be optimum if I have more debt. Even I go with the 100% debt, it can be my easy capital because the risk is hand over to the investors. I'm just using their money and running my business. It ignores situation of bankruptcy and also ignores the cost of equity contributions and its advantages. So the net income approach only focus that income available after paying debt interest should be maximum. So as per this approach, if I invest more in debt and less in equity, it will give me optimum capital. Whereas if I invest in equity capital, that is own capital, then I need to repay a higher value as a cost of investment. So it suggests avoiding more investment in equity capital. Now I'll come to this after I've discussed the three theories. Now let's take an example. Market value of equity is 500 and debt is 300. Please remember, this cannot be always a situation. It can be reverse way. The debt value can be 500 and equity can be 300. But because the basic assumption of this theory is cost of equity higher, we are considered high value. So our operating income is 80. Then in that case, net operating income, that is a profit, divided by 500 plus 300, what I'm getting is cost of capital 10%. In reverse way, if my value of debt is more low, I should focus on more debt because the denominator 80 divided by 300 plus 300, if it is 600, then the percentage will change. So, as per this, the cost of debt, which is lower, will be great. But in case cost of equity increase, it is never welcome. So, cost of capital remains constant under specific debt equity mix. And if the proportion of debt increases, the value that is we are getting 10% will start reducing. And when the cost of capital will start reducing, you will start getting more profits. For example, if furthermore I can add 80 divided by 600, then the proportionately the value which I get will be less than 10%. And if value is less than 10%, then what I am achieving that I out of 100 rupees, the less amount I am repaying. For example, earlier it was 10 and now I am paying something suppose around 8%, then 2% additional income is generated out of nothing. And that's why this is called as net income approach. So my profit minus interest or dividend, if it generates or if it saves something, then it will be there. But condition is that cost of equity and cost of debt, this should follow these relations. Any doubt in net income approach? Now, what is real world? In real world, the taxation part is going to be there. There should be intervention of government, and if cost of equity is higher and cost of debt is lower, then the restructuring will happen. Similarly, if more and more borrowings, there is something called as the financial distress. There is something called as inflation. There is something called as a higher cost of administration. So this cost and relationship between stakeholders will be a crucial issue. This theory is only perpetual that whatever the value of equity and value of debt should be in relation, that equity value is more and debt value is less. So they are only focusing that high leverage, admin cost, and stakeholder relationship, these factors are not taken into consideration. As per them, cost of equity is more than cost of debt. So if I want more profits, if I want more cost of uh, benefit for company, then I should consider that the capital value should be less. And if I want cost of capital less, then I should have less equity and more debt. But what it fails that the tax benefit cannot be same. Similarly, investors can demand high returns if the profit is high, as well as a financial distress can be created if the leverage increases or if this kind of situation increases. Because when cost of debt is high, sorry, equity is high, then demand for debt will increase. And when demand increases, the supply for debt will not be so high. In that case, there will be increase in cost of debt and the theory fails. So whatever the three assumptions are there, they fail, then this theory also fails. So this is a degree of leverage and cost of capital. Now leverage means it can be financial and operating leverage, both the leverages. In that, overall cost will start declining when the debt will be more. So theoretically, it's only a graphical presentation to show that optimum capital structure occurs when maximum debt at maximum level. So in this graph, this debt portion is on higher side, whereas the cost of equity, because here it is a cost and it is quantity, I should more focus on equity and I should avoid, sorry, I should more focus on debt and I should avoid equity because value of equity is high and value of debt is low. So in a capital, I should find out equity small and debt more. How much I increase the debt portion, that will reduce my cost of capital less. And when my cost of capital less, I'm getting more dividend part. So this is all about this theory. Anybody has any doubt in this theory? Now let's talk about implication. Now this theory was limited and applicable in limited circumstances where people believes that income is more important rather than source of income. If I have only debt that is outside investment, that will always create a financial distress and administrative burdens. But this theory advocates that if maximum debts And if you manage that debt in real condition, it will help to get more wealth creation for equity owners. Very less equity owners will give an ability to make quick decisions. Third, less equity members and more borrowed capital at lower cost will give investors maximum wealth creation. So, based on cost, it accounts that if cost of equity is more and cost of debt is less, then please go with the borrowing. Don't raise your own capital. So, conclusion, this theory has a theoretical foundation of three assumptions that borrowed capital is cheaper and my own capital is costly. So if I want to raise a capital, I should take care that whatever the cheaper, whatever the less cost, I should borrow more. And I should make a capital structure in such a way that my borrowings will be more and own capital will be less. Then my total cost for raising capital for my business will be less. And if that cost is less, ultimately profit for my business will be higher. So that's what we call net income approach. Anybody doubt about net income approach? Now please remember this approach is based on that I should get income maximum. Now there is one more theory which is called net operating income. So if no doubts, I'll switch to the second theory. If you doubt, you can also ask me in chat box. Okay, I'll start with the second part. The second theory of capital structure is net operating income. The first was net income, and this theory talks about net operating income. So please remember, operating income is a different part. The first one is was net income, and second theory, what we're talking about, NOI. So this O has a larger meanings. This theory gives an idea that investment analysis and fundamental concept. As per this theory, let's understand the foundations, what they are saying. According to them, when a business is running, they should understand how much the net cash flow of money is remain with them. So, as per this theory, what is my operating income and what are my operating expenses? That is interest and tax. These are my key indicators that how much income is available to the equity owners or to owners. So out of my 100 rupees earning, if 90 rupees are given for outside people and 10 rupees is retained, then chance to grow my business will be limited. And reverse way is suppose 10 rupees are given to the outside and 90 rupees are retained in firm, then growth will be high. So it follows Durant principle, but here for them, income available after operating expenses, but before interest and tax is most important. So operational efficiency plus cost of capital is combinedly analyzed in net operating income. Now, if I compare both the things, in net income, it includes all expenses, but in operating income, it is only operations. Here, in net operating income, it do not consider any taxes. But in net income, it consider taxes. It do not add depreciation, capital expenditures, and financing cost. And everything is added in case of net income. So basically, the net operating income, what we call is a gross profit approach, and net income is nothing but net profit approach. So operational income, which I'm going to manage, is not having any borrowing, not having any depreciation, and not having any capital structure. It is only available in net income approach because it considers overall. And in net operating income, my importance is given towards operational efficiency or operating income. The net operating income calculation steps, it first derives what is my income, that is revenue. Then I find out my operating expenses. So out of my income, I reduce my operating expenses. I find out net operating income. Then from that, I reduce financing and taxes. And after financing taxes are deducted, I'll find out what is my income that is available from operations. And based on that, I'll call cost of capital. Now let's understand how the operation income is calculated, and then I'll explain the difference between two theories. For example, if my business is of rent, then I required maintenance, I required taxes, I required utility bills to be paid, I required admin charges, the manager who was looking up my houses. My income will be from rent, and other income will be from parking, laundry, wedding, and fees. The net operating income will not consider ancillary income because for net operating income, my only income should talk about my core part, and this ancillary income is not my core part, whereas it will not take in consideration operating income. So these things are ignored in net operating income. So what is not included? It not include administrative tax, depreciation, capital, and other principles. It basically only focus on operating income. Now let's talk a real example. My real income from rent is 6 lakh. Okay. My ancillary income is 50,000 and my operating expenses are 2 lakh 50,000. Now, if I take it total, my total income happens to be 6 lakh 50,000 because this is from my operations and my operational expenses are 2 lakh 50,000. So after deducting from 6 lakh, my income will be 4 lakh. Now this is my calculation of operating expenses. But in case if here if I received something called as deposit or I require to pay the insurance for a house or I require to pay municipal taxes, these figures are not considered under this thing. This only talks about my income minus my expenses. And what I get is my net operating income. And what is impact over my net operating income about debt and of equity we'll talk about in net operating income approach. According to this theory, what is a capital structure? That is debt or equity, and its mix. It is not so important. What it says, if my operations are effective, it will not be impacted what is my capital that is borrowed or equity. As per this theory, please remember, as per this theory, cost of capital will be constant and there is no impact or debt and equity mix on cost of capital. But what is important is operational profit or operational income. So how business generate operational profit, to be very precisely, gross profit that will take how much investment and how much capital structure I'm doing. So here cost of equity and cost of debt, these two factors are not in existence. These two factors are not in existence. Financial risk to the equity holders and debt increase the cost of capital and offset cheaper benefits. So, as per this theory, how much profit I'm getting after operations, after paying interest and debt, is more important because risk is there. Risk is there in equity as well as debt. But financing risk to the equity holder rise with the debt and increasing cost of equity to offset cheaper debt benefits. So in net income approach, he ignores the risk. What he is given important that it is cheaper to take others' money rather than investing own. But in net operating income, he wants risk can be there if I take more loans. So instead of more taking loans, invest own capital, but make sure that whatever the income generated by operations is higher. So to repeat again, what are the key assumptions? Cost of equity, cost of debt, and economic system, they remain constant. The value of firm will be not affected by any composition or mixture of equity and debt. In market, all the people has symmetric information. Symmetric means they have parallel knowledge source where they are getting same information about market. Then the firm's investment strategy will be only impacted by operational profit and its strategies. If the operational profits are greatly managed, then how much borrowings I'm doing or how much expenses I'm giving, they are least considered and I can manage my capital more effectively. So if I compare this with net income approach, net income approach says composition of debt and equity will make an impact on overall capital. But as per net operating income, operational efficiency is the only important. How much is my own capital, how much is my borrowed capital is nothing to do with the value of firm. And if I consider the next approach, what we're going to discuss, it says optimal capital structure exists when the debt or equity is generating income. So marginal cost, if generate maximum revenue, then it is the best. So if I consider three approach, what I can find in net operating income approach, capital structure is not important, but offsetting and cheaper capital is most important. Whereas in net income, it says capital structure is important and more debt is beneficial for cheaper financing. But here in net operating income, operational efficiency is important. And in traditional approach, which is the next part, the marginal cost of debt should be less than the marginal revenue. So if this is less than MR, here I want operational profit or operational income. And net income approach, my debt should be more than my equity. So for anybody, any doubt? Okay. Then I go for the next. So for this, the property or value of firm will be net income divided by capitalization. For example, net operating income is 4 lakh and cost of capital is 5%. Then value of firm will be 80 lakhs. This explains that whatever mix of debt and equity is not important, but how much efficiency I'm showing in managing the business rather than focusing on non-operating income or non-operating expenses. I need to generate my internal efficiency so that I'm getting more on more benefits. In real world, this approach is very conservative because this focus that internal source or internal efficiency is always important rather than focusing on uncertain part and creating financial distress, because how much operational efficiency I create is more important rather than how much mixture or what is the proportion of borrowings and own capital. Because controlling debt is very tedious task, and if I control my operating income in more profitable way, then mixture will not impact on my capital structure and my firm value can be maximized. Now, what is limitation? Normally, all theories, whatever the assumption they are making, they are limitation for the theory because the mixture of capital has influence over my income. Similarly, ignoring value of depreciation, administration cost, leverage value, and time value of money is making impact over operational efficiency. And that's why the operational approach has limitation of ignoring the realistic concepts. So this is about net operating income. So far, anybody, any doubt? Now let's talk about the last approach towards capital structure. The last approach is known as traditional position. Now, traditional position and other two approach, the difference is that first approach talks about cost of equity and cost of debt. Second approach talks about operational efficiency. And now the third approach is talking about a traditional method to recognize profit or loss. As per this approach, value of firm is critically designed and analyzed based on how much returns you are giving to shareholder as their wealth creation. If your wealth creation is maximum rather than only giving dividends, now there is difference between earning profit and wealth creation. If more money is retained, for example, if I earn 100 rupees this minute, if I earn 100 rupees and 90 rupees are given outside person, and 10 rupees are with me. So this is given away, and this is with the business. So in future expansion, I have only limited funds available. So why I'm giving 90 outside? Because it can be interest, it can be dividend, or it can be anything. But in reverse way, if 20 rupees are given outside and 80 rupees are with me, this 80 rupees further they can invest in fixed assets and they can create income. So I have optimum capital structure when I follow that maximum money is retained and I will avoid giving maximum outside. So instead of giving profit, my interest will be maximum money to be retained in organization. Now, as per this, decision what companies take and make are profound of financial risks. If they talk about profitability, they talk about market value, and they talk about mixture of equity and capital. What is a capital structure? Capital structure is a combination of different assets. It's a combination of source and application of capital money, where I need to analyze returns, I need to analyze risk, I need to analyze the long-term associated value and steps or amount of regeneratives. Now, what is this theory talk about? As per this theory, the initial value of my debt will be high because I'm not generating any expenses. I'm just borrowing money. So initially, my cost of borrowing will high, and when I progress further, when I start earning more and more profits, its value proportionately start declining. So when my production is zero, and if I have to repay 100, then my cost that my income is zero and expense is 100, then cost will represent more. Whereas when my turnover change to 1000 and my expense remain 10, then the proportion will change 10%. So as my operations, my business or my profitability increases, the cost of debt will start lowering down. So as per this approach, they believe strategic management of debt will impede that overall profitability and overall cost will come down. So in simple, what I can say, the quantified method where this approach advocates that when my business from 10 rupees reach to the 100, it further goes to the 1000 and 5000. Suppose my cost of equity is 1000 and my cost of capital is 1000. Then when it is only 10, my business will be a question. When 100, it is a less. When 1000, it is, I can say, break even. And when it is 5000, this is 5000, sorry. When it is 5000, it is in profit. So when my business progress in quantity, my profits are more, then it will lower down cost of capital. So as per traditional approach, my business turnover is more important. As per this approach, how much money I'm earning, when it start more and more earning, the cost of capital will start reducing. To explain this, I'll again start a whiteboard. Now, let's talk about my business is of 10, then my business is of 100, my business is of 500, my business is of 1000, my business is of 5000, my business is of 10,000. So, initially, when I start a business, I required cost of capital. This cost of capital is mix of my debt plus equity. So I have my own capital of 100 and borrowing of 1000. So this totally will be equal to my cost of capital as 1100. So in initial phase, it cannot be recovered here. So I'm getting loss, and it will start earning something after this point. So when it is more, that is my turnover is increasing, then cost of capital will start reducing. So as per this concept, when I have quantified more and more, like in normal life, if I buy one quantity, then cost will be high. So less quantity, more cost. But if 100 quantity, this cost will be getting down. And this is nothing but a traditional approach. Now, for traditional approach, they follow one important factor, which is called as weighted average cost of capital. So, strategic use of debt will reduce cost of capital when my production increases. And what is strategic use of debt? The weighted average cost of capital is the concept where I have to allocate importance to the equity and importance to the debt in proportion. Suppose I want 10% equity and 90% debt. It's my choice. Or I want 80% equity and 20% debt. It's my choice. So I can compare anyhow, any firm, and I can decide. So we already discussed the equity, that is a percentage assigned. So please remember this formula you need to remember for understanding traditional. As per this, if my cost of equity, sorry, if my weighted cost of capital is lower, then my income will more and I have optimum firm value. What is the percentage of capital? That is, if out of 100, how much is debt and how much is equity? It's your choice. What is important that what tax rate you follow and what weightage you give. But it should combine in such a way that overall this capital should be low. So your decision and investment skill, they are important. So it says your income approach is important. Similarly, your operating income approach is also important. So what I can say, traditional theory, it's a combination of income approach and combination of operating income approach. Because here it advocates mixture should have lower value as well as it should start declining overall firm value when my operational inputs start increasing. So I should have weighted average cost of capital lower. So I need to manage equity and debt in such a way that the capital will be optimum, and also take care that in long term, as the time value of money, it will generate more and more income because the cost of initial investment will go down when my business starts earning more due to two factors. One, future value, and second, my turnover. So these are the three approaches towards capital structure. Any one approach cannot be said perfect, but the traditional approach talks about combination of both, and it considers all the factors moving, very less real factors. Even it considers tax, it considers financial distress, it considers projections, it considers ability and risk. And that's why traditional is more positive. As per this approach, financing decisions are very important. In business, earning potential and investment policy are not a key decision because earning potential is an ability which can be judged, whereas investment policy is not required. Now, please remember, mixture of equity and debt is not considered here. This is investment policy. It is considered as a capital. Investment policy means the instrument where I can have savings and will generate income. Similarly, market has flow of investors and they ignore other factors rather than market conditions for making their decisions. And there is a relation between debt and equity is always a changing based on profitability, based on assumptions, and so on. It always changes. So, as per this theory, more practically, the firm's underlying assets cannot be changed overnight, but the profitability can be changed when my weighted cost of capital is optimal. So, according to this theory, it is very important for me to manage my firm's value based on debt and equity proportion if I'm able to analyze, if I'm able to check how much profit I'm getting and how much profit I'm not getting. So, as per this concept, weighted average cost of capital is important and the firm's turnover is important. If the firm increases its cost of equity or debt, it is least bother until I have income to finance the. So, just a small example. If I have combination and I have risk, then I find out earning capacity. If in this example, if we say 100% equity, or if I take 30% debt or 70% debt, the earning per share changes. So when 100% equity, earning per share was 75, but when I have 30% debt, earning per share increases. So it start reducing because I'm paying interest rate. So when I more debt, more interest is paid, then EPS is lower. So I need to find out a structure where the combination is there because 100% own or 100% borrowed will not enhance my profitability. So I find for our example, because only three rates are I'm taking, 30% is optimum. It's not too low, not too high. So I can select this combination. So to conclude, operating income approach says income is most important. So if cost of debt is less, select cost of debt, not equity. Whereas operating income approach says capital structure is not important. What is important is rise of firm's operational efficiency. Whereas traditional approach says both operating income and net income they are important, and it has to see a such a mixture that weighted average cost of capital is less so that you get more profit. That so in short, traditional approach says earning per share is most important. So the last part About Noodle Miller, we'll see it tomorrow. And this is all about capital structure. So far, anybody has any doubt? Okay. If no doubt, we'll call off for the day. Enjoy your glories, and we'll meet in the evening for direct taxation. Thank you.